Hello, everybody. Welcome back to my Daily Dose with Tim. Today is season 3, episode 40, and it is also part 10 of the subject lease options, or as I like to call it, how to execute lease options the right way. And so we're 10 episodes in really on this subject. And as I mentioned, this has been growing very organically throughout for the entire season right now. And today, just a bit of a grand finale in a way, even though it really isn't, because I've got a couple of case studies that I'm going to be covering with everybody starting the next episode as well. However, today, because of the example that we've been working on and some of the business decisions and the thought process that I've walked everybody through, I want to make sure that everyone knows how this actually shows up in every single deal, and in this particular case on a spreadsheet. Because at the end of the day, we always say, as educated and professional investors, you gotta let the numbers do the talking. I know this particular strategy is very emotionally charged for many of us, including myself. At the same time, though, as investors, especially when you are working with other people's money, I always say it is our duty and our privilege to be able to share the wealth. At the same time, that's just it. It's about sharing the wealth. And what that means is we got to make sure that we are at every single turn, not only helping people protect their hard-earned money that they've entrusted with you, they are also growing their money at the same time. Sometimes it's really funny. A lot of the investors, especially the newbies or amateur buyers, they only focus on growing, or at least it's their definition of growing by just acquiring properties rather than focusing on performance. Now, let me ask you this. Even with any other investment vehicles, would you continue to park your money there if it's not growing? No. And so this is why the funny thing really about real estate sometimes is that people do kind of get it all mixed up a little bit just because it's a physical hard asset and there's a lot of misconception around it. Okay. So anyways, coming back here now, I'm going to be pulling up the spreadsheet that I'm hoping that you're all familiar with now at this point. And on that note, what that also means is if you're not, and this is the first time you're watching my Daily Dose with Tim, and this is the first episode that you're watching on lease options, make sure you pause, stop there, and you at least go back to season 3, episode 31. And I know many of you have been consuming season 1 and season 2 already in the background. And if you're curious about where everything is hosted, I'm going to share that link in the comments section below as well. And the other thing really is next week, I'm going to be sharing why this strategy is so powerful purely from an investor's perspective. Okay, I'm going to be sharing that with you. However, coming back here now, I'm going to reset everything. As you know, yesterday we actually looked into some different scenarios as well. And today we're also going to further do a deep dive into it. And if you remember, this is literally the deal. 3-year lease options, rent to own. Total profit is $77,750 based on an Edmonton example, Edmonton, Alberta, Canada. So for those of you who are in other countries, remember your numbers may be a little different given the different considerations that you will build in. And return on investment on an annual basis is roughly about 29.5%. And your tenant buyer at this point should successfully be able to pull the trigger on exercising their option to purchase based on that total option consideration amount that they have accumulated with you. And I'm going to build in a few different scenarios for everyone. And I know that I think I have a much bigger, as far as Canada is concerned, a much bigger audience in the Ontario or Greater Toronto area. So what I'm going to do is, because many of you actually gave me the feedback that you really like the fact that I actually put in land transfer tax yesterday or in the previous episode. So I'm going to say, I'm going to leverage that. Okay. I'm going to leverage that as how we're going to approach today's episode, okay? So now the purchase price is $586,000. If you remember, going back to the Canadian Mortgage app, you are able to find out how much the land transfer tax is when we're acquiring that property up front. And so as a result, it does fall into the initial investment section of the spreadsheet. So at this point, we're looking at 8195, okay? $8,195. And so really ultimately what this changes is right off the bat, your total initial investment. And so again, in your mind, when that changes, okay, when that changes, what happens? What happens is your ROI will go down, okay? Remember, return sitting on investment. If the initial investment amount goes up, that means your final number goes down. And in this case, that is your ROI. And I also want to quickly adjust one place just so that some of you that might be watching this, or you're just very, very analytical about things, remember, this was the previous episode's example. So I'm going to take that out for now or put it back 586. Remember, the accepted offer needs to be lower than or at the very most equal to the appraised value, which is technically your comp, okay? Your competitive market analysis. And let's move forward here. And at this point, we also said because it is in the Ontario market, it is a 6%. It is a 6% annual appreciation, okay? And so it's very, very different. And now that you remember that example, guess what? We actually need to come back now and readjust once again on exactly how much the current maximum purchase price is. And so let's take out our calculator. I know this is one of those exercises that so many people need hand holding on, because it is really just doing the compounding backwards, okay? So if your tenant buyers are only still qualified for 650,000, because you can also compound forward. However, remember, it's always about the end goals in mind. And so if the end goal right now is that they are able to get pre-qualified for $650,000, that's the number we're going to be using. So on your calculators, punch in $650,000 divided by 1.06, because we did say that we're using 6% as our annual appreciation rate. And now we actually are depreciating backwards. So it's divided by rather than multiplying. And you got to do it 3 times. Why? Because it's 3 years. And so right here we have 545,000, okay? 545,000. And 752, if you remember, we're going to shrink that down because this number represents the current maximum purchase price. And so if the accepted offer or current maximum purchase price is 545,000, that also means that from a comp standpoint, just so that we're on the same page, is 545 maximum also. Okay, just so that the spreadsheet is clean and there's no misunderstanding here. And as a result, we fix the option to purchase price for the tenant buyer at 650,000. And when we go back to our purchase calculator, now we got to change that number up to 545,000. And what that also means is within the land transfer tax column, okay, it is now, instead of 8195, it actually goes back down to 7375. So some of these numbers you're probably already familiar with because of what we went through in the previous episode. And at the same time, though, I want to do it again just because repetition is very, very important, and hand-holding is also really important in my opinion, especially if you're starting to just make sense of the strategy and how all the numbers show up, okay? And so at this point, we are looking at going back to our purchase calculator, and let's take a look at the amortization schedule. we say that after 3 years, the balance is 417,483. And I'm going to round it up to 418 because it is a debt, which means it's an expense. If you remember, I always like to underestimate revenues and overestimate expenses, just so that there are no big surprises at the end. And when you're doing that and everything goes as planned, then you're finding extra money. And so there's nothing wrong with that, right? I think that's a happy day for a lot of us usually. And moving forward, nothing else changes here. And we did mention that even if we fix the average fair market rent for this deal, we are still doing pretty well and at 4203. So that number didn't really change here. So what I'm going to do is our mortgage payment now, once again, in this case is 2485. So I'm going to do 2490. Okay, 2490. So if you remember, it is now $1,063 on a monthly basis. So coming back up here now, once again, total profit 116,235. I want to make sure that everybody follows through. Okay, so 545,000 is the current purchase price for us as investors. Let's assume that we get a 80% loan to value mortgage. That means we got to come up with 109,000, and then we factor the legal fees, the appraisal, the inspection, and land transfer tax at this point, and no other fees just yet. And their option to purchase 650,000 after fixing the mortgage terms and rates. We know we owe 418,000 3 years from now, and legal cost of closing is 2,000 once again. And we take out the initial investment, we rebate them back everything that they've contributed. So at closing, we get to pocket nearly $78,000 when they become homeowners. And fair market rent, I'm just going to say 3,300 right now. I know some of you guys might say a property like this may be a little bit more, a little bit less. That's completely up to you. However, now that we're on the same page about all the numbers, I am going to build in, first of all, what I call the best case scenario. Okay, I'm going to write it back up here. The best case scenario. So some of the thought process that we will walk through right now is what might be the best case scenario. First thing first, from a loan to value perspective, 80% loan to value, in my opinion, is the best case scenario right now, especially in Canada. And so we're not going to change any of that. Now, depending on if you've got experiences building your teams, sometimes you may have a mortgage broker that you're working with, that you've worked with a lot of the times, and they say, you know what, you're a volume customer, I'm not going to charge you appraisal. Sometimes their brokerage will actually cover appraisals too, completely up to you. But I'm going to say, I'm going to zero this out right now because that amount is non-existent. And also, from an inspection standpoint, assuming that you are an educated and professional investor, meaning you've got volume-based business and you've got an inspector in a market that you specialize in with this particular strategy, maybe you got a punch card system, or maybe you've just got a volume deal. Instead of charging you $650, they are going to just charge you $500 flat for most single-family homes up to a certain either value or, in this case, a certain size usually. Okay, and so as a result, you can see now your total initial investment is a little bit lower. Okay, now in this particular case though, I'm going to say the sale and transfer price, again, you might be in a market where in the last 10 years or 20 years, the average is actually even a little bit higher than that. So when that is the case, let's say we're not going to go too overboard. I'm just going to raise it by about 0.25%. How's that? Some people will go, well, no, I mean, I've seen people that use 7%, 8%, especially around the GTA. And I'm going to say, maybe don't do that, because at the end of the day, yes, you could potentially do it. However, we are still looking to make sure that the tenant buyers qualify and it's an all-around win-win-win-win-win, because you can manipulate, that's the word. You can manipulate the numbers on the spreadsheet as much as you want to make you feel better. However, is it realistic and is it attainable? Those are still a major consideration you need to remember. And so as a result, what happens here now is if it's 650, instead of a 6%, increase on an annual basis, we're doing 6.25 now. So you take it once again and you divide it by 1.0625. Okay, so I'm going to do it again just in case. 0.625 divided by 1.0625 divided by 1.0625. And so now all of a sudden it changes our current maximum purchase price. So it goes down to 541,000. Okay, it goes down to 541,000. And guess what? We're gonna have to come up here and clean up one thing very quickly. That is our land transfer tax. Because when we change the home price to 541, you will see that the land transfer tax is now 7,295. So not a huge difference. However, it does all add up. And so moving forward and assuming that maybe this is your first or second rental properties, and because of your own qualification, you're able to actually lock it in at an even better rate today. Instead of 5.6, I'm going to say 5.5. Again, you can see that even the best case scenario, I am not going to overboard just because some of these factors we don't have 100% control over, but we are relying on mortgage brokers, realtors, real estate boards to provide the due diligence to make sure that our reasoning and logic behind how we put in these numbers are still sound. Okay. And so on that note, 20% down, I'm going to do 5.5 now, and 30-year amortization. That's probably the best case scenario that we can have these days still. And so from an amortization schedule perspective, after 3 years, we owe about $414,105, and the same principle apply. I'm going to round it up to 415,000 in this particular case. And then we move forward. There's no penalty, no nothing else. And the option consideration on a monthly basis is still the same. And so as a result, this is our total profit when our tenant buyers are qualified and choose to exercise their option to purchase. Now, coming back to average fair market rent, as we mentioned, this property could be $3,000, could be $3,600 in fair market rent on a monthly basis. And we can say, you know what, let's push it up to $3,500. If your business decision is that you're going to push it to the absolute highest end at $3,600, and the market does appraise and bear that value, go for it. However, as you can see, I'm still being a little bit more considerate and a bit more careful, even though I'm calling it the best case scenario. Okay, so we're going to put it at $3,500 right now. And assuming that you also got a decent insurance rate, maybe it is $120 right now on a monthly basis, but because we are basically in a way forecasting it for 3 years, I'm still going to just take out about $10 on a monthly basis. So there you have it. Right off the bat, you can see on a monthly basis, the cash flow is 1,273. And your ROI on an annual basis now, when we scroll all the way up, is 50.03%. 50.03%. And then total profit from the deal. Okay, total profit from the deal is 128,325 as a result. Okay, so this is what I would call the best case scenario. However, we also need to build in the other side of the spectrum, because this is the one thing that I learned really early on, and as I call, business decisions. And business decisions are made based on one very simple principle is, as a business, we are constantly looking for ways to maximize profit or minimize loss, okay? So at this point, let's take a look. So assuming that nothing up here changes because that's our current purchase price and there's no money in the buy, okay? And as you can see now, based on the last few episodes, you can also play with those numbers a little bit because maybe the comp is a lot higher and your accepted offer is a lot lower. And remember, you can build that in too. And if you want me to show that and show that on the spreadsheet, I will make sure to do it in the next episode. Just DM me, okay? And so on this note, I'm going to change the loan to value now right off the bat to 75%. So what that means is 25% down right away. Okay, it's 20% down right, 25% down right away. So that changes the number. And also, again, coming back here, assuming that appraisal still stays and your inspection also stays. Okay. And in this particular case, because we didn't change the purchase price, so the land transfer tax amount is still there. The land transfer tax is still there. Now, assuming that you found this particular deal through your network, okay, you found this particular deal through your network. So technically here it's HST and GST. So HST in Canada stands for homogenized sales tax. Okay, and so in Ontario, for those of you who don't know this, usually it's 13% on top of whatever it is that you are buying. And assuming that the wholesale fee is $5,000. So if it's $5,000, we add 13% tax on top of it. That turns out to be 5650. Okay. That turns out to be 5650. So now you have a new total initial investment. And now moving forward, we're going to come back, okay, and say that, okay, you know what, the sale and transfer price, we are actually going to fix it at maybe 5.8%. Okay, now all of a sudden, I hope this is now triggering this thought process. What do we got to do now? We got to go backwards one more time. So divided by 650,000 divided by 1.058 divided by 1.058 divided by 1.058. And so what that means now is right here, 548 is our current maximum purchase price. Okay. You see how one thing triggers the change of another. These things don't move much anymore. And we know one thing will change when the purchase price changes, which is our land transfer tax. And in this particular case, 548,000 gives you a land transfer tax amount of 7,435. 7,435. And so coming back here now, we have a new total initial investment. So that's good. That's checked. And if you want to say, you know what, you haven't really been fully qualified yet, but you're looking around at the rates these days and you're like, oh, okay, I think I'm going to be budgeting in my rate at 6.2%. 6.2%. And I'm only getting 25 years of amortization, okay? Because for whatever reason, they're not going to give you 30. The longer the amortization, the lower the monthly payment is. So in this particular case, we're just going to say 25 years. And so when we go and look at the amortization schedule, you will see what we owe now is $388,062. So I'm going to round it up to 389. Okay. And now we're closing, paying ourselves back, and assuming that there's still no penalty right now, okay, because they're closing on time. And then you're going to go option consideration is still the same because we did not change their option to purchase price at the end there. And some of you will go, you know what? We say 3,000 to 3,600 as we mentioned earlier. I'm going to fix it in, even though it's not 3,000, I'm going to do maybe 3,100 because this number does not change for the next 3 years. Okay. And then coming back now, we need to put in our monthly payment, which in this case turns into $2,678. So I'm going to round it up to $2,680. And coming back, insurance, I'm going to bring it back up to $150 a month. In this particular case, I might even say, you know what? No, I'm going to go up to $180 on a monthly basis. And now you can see the total profit from cash flow is now $643. Okay. So worst case scenario, cash flow is $643. And your ROI now, let's go all the way up, is 26.62%. And your total profit is now $96,405. Okay. So I know there are a few more things that we can play with. However, at this point, I want to stop sharing the screen and bring you back to everything that we just went through here as a summary. Okay. Look at this. It depends on really what is important to you. As I keep saying, at the end of the day, everybody's gonna make different business decisions to make sure that you can still sleep at night. Okay, so you're not kept up stressing about money, because after all, this is really my personal goal for financial education, is that nobody should be stressing about money as long as you understand how to calculate your risk tolerance before you walk into any deal that you want to do. And so best case scenario, obviously, numbers are a lot stronger than the worst case scenario. The question really is, would you still do this deal if the numbers are like this? I'm going to say yes. It's a single family home and you're still cash flowing $643. Think about what an additional $643 can do for you on a monthly basis, first of all. Second of all, you have a piece of hard asset and you are making on average 26% return on investment of your money. Where else do you go where you can have 100% control of your own investment and make 26%? And last but not least, in 3 years' time, you're making a total of $96,000. That's basically an additional $32,000 coming into your pocket. Okay, so I've had people, business owners that are students that became educated investors. They're looking at these numbers going, oh my goodness, even on my best day, I couldn't even pay an employee to make this kind of return on an annual basis. So just look at the numbers and make those decisions for yourself. I mean, again, this is basically very flexible. It's endless almost, because there's so many different considerations that we can build into the spreadsheet and see how the numbers show up at the end of the day. However, I'm going to say, I hope that this has really given you some insight into this particular strategy. And as I mentioned, if you want to cover more, make sure you message me, reach out, let me know so that I can continue on. Right? Like I said, this whole season is growing very organically so far. And also in the next episode, I will leverage one of the case studies, or actually it's a live deal that you've sent me to go over with you, just to see what kind of considerations and what kind of questions I would build in. And incidentally, if you were to do a deal like that, it will fall under more on the other side of the spectrum. Why? Not because it's a bad deal, but it's because of the fact that it came from somebody else. So paying somebody else a fee is already built into this particular deal that we're going to be walking through together. So on that note, thank you so very much for sticking with me for 40 episodes so far. And I don't know where you are right now. Most of you, you're like me, we're Canadians. happy Canada Day long weekend this week. And I will be back on Monday the 3rd, no matter what. So I'll see you back here at the next episode. Have a great rest of the day and have an amazing Canada Day long weekend. Live well, everybody.